and economic developments around the world. Over the last few weeks, the pillars of the old order, the free trade, multilateralism, and globalization, have come under intense pressure and seemingly giving way to an era of on the domestic front, the economy remains in recession and inflationary pressures are yet to dissipate. Both external and domestic conditions have blended to significantly complicate the policy environment. In attendance at the meeting were 10 members of the committee. The committee reviewed the global and domestic economic and financial environment in 2016 and the outlook for the short to medium term in 2017. The uncertainty in the external environment persisted owing to a combination of recent political and economic developments. The key issues include Brexit, the rising wave of populist and anti-globalization sentiments, anchored by emergent bilateralism, divergent monetary policy stance of the advanced central banks, and disorderly commodity price movements. With global output growth improving sluggishly, the outlook for 2017 remains unchanged, owing to persisting uncertainties in commodity prices and volatility in financial markets, as well as slowing demand in the advanced economies and the emerging markets. The MPC welcomed the modest increase in oil prices following the last OPEC decision to cut output and noted the increase in the policy rate of the United States Fed in December 2016 and the potential implications of that decision for international interest rates and capital flows. While noting the materiality of the output cut on oil prices, committee cautioned that the effect could rapidly wane given a likelihood of a supply glut from non-OPEC members, low level of global economic activity, and weak growth. Emerging markets and developing economies in particular have continued to confront strong headwinds such as low commodity prices, rising inflation, currency instability, intractable low aggregate demand, and subdued capital flows. Overall, the committee noted that whereas improved commodity prices may provide modest tailwinds for resource-dependent economies in 2017, the medium-term outlook continues to be muffled by stagnation and uncertainty in the prospects for global trade, subdued investments, and heightened policy uncertainty, especially in some major economies. Nevertheless, the IMF estimates that these constraints will decline, paving way for mild improvements in economic growth from 3.1% in 2016 to 3.4% in 2017. Global inflation commenced a moderate but steady rise on the backdrop of improvements in oil prices and currency depreciation in several emerging markets. However, amongst the major advanced economies, only the US Fed has commenced policy tightening, while the Bank of Japan, the Bank of England, and the European Central Bank all retained their accommodative policy stance at their most recent meetings. Domestic output development. Data released by the National Bureau of Statistics in November 2016 showed that the economy contracted further by 2.24% during the third quarter of 2016, having slipped into recession following another contraction in output during the second quarter of 2016. Although the overall contraction during the third quarter was greater than was observed during the first and second quarters, the non-oil sector grew by 0.03% during the third quarter, driven mainly by agriculture, which grew by 4.54%. The committee is of the view that the key undercurrents, that is scarcity of foreign exchange, low fiscal activity, high energy prices, and the accumulation of salary arrears cannot be directly ameliorated by monetary policy actions. The committee hopes that the recent increase in oil prices will be complemented by production gains to provide the needed tailwinds to sustainable economic activity. In that regard, the committee recommends the commitment of the fiscal authorities to step up efforts to fill the aggregate demand gap through a speedy resolution of the domestic indebtedness of the federal government to states and local contractors. The committee believes that doing so will aid the efforts towards economic recovery. Developments in money and prices. Committee noted that money supply grew by 19.02% in 2016, being 8% points higher than its programmed limit. It underscored the necessity of keeping the economy adequately lubricated in the face of declining output. Growth in the net domestic credit was 24.79% at the end of December 2016, being 17.94% above its provisional benchmark for 2016. Likewise, growth in the net credit to government at 58.84% surpassed its program target of 47.4%. In effect, all the major monetary aggregates exceeded their program provisional benchmarks for the fiscal year of 2016. Headline inflation year on year continued to rise, creeping up in December 2016 to 18.55% from 18.48% in November and 18.33% in October, thus sustaining the upward momentum since January 2016. The increase in headline inflation in December 2016 was driven by an increase in the food component, which inched up from 17.19% in November to 17.39% in December. Core inflation, on the other hand, moderated slightly to 18.05% in December 2016 from 18.24% in November. Committee observed the increases in the month-on-month inflation rate in November and December, in contrast to successive declines between June and September of 2016. It noted that the structural factors driving the sustained pressure on consumer prices, such as the high cost of power and energy, transport, production factors, as well as rising prices of imports, are yet to abate. Nonetheless, the committee estimates that the current policy stance and other measures directed at improving food production would combine with base effects to usher in some moderation in consumer prices in the short to medium term. Money market interest rates fluctuated in tandem with the level of liquidity in the banking system. Thus, average interbank core rate, which stood at 15.34% on 21st of November 2016, closed at 9.90% in December 30th of 2016. Between these periods, the interbank core rate averaged 13.59%. The average interbank core rate, however, fell to 3% on December 9, 2016, due to an increase in net banking sector liquidity to 495.48 billion naira on December 8, 2016, following the payment of statutory revenue to states and local governments, as well as maturity of Central Bank of Nigeria bills during the period. Committee welcomed improvements in the equities segment of the capital market as the all-share index rose by 2.84% from 25,499 on November 21, 2016 to 26,223.54 on January 20, 2016. Similarly, market capitalization increased by 2.5% from 8.8 trillion naira to 9.02 trillion naira during the same period. Relative to end of December 2016, the capital market indices, however, fell by 2.04 and 2.05% respectively, reflecting the challenges confronting the economy. Total foreign exchange inflows through the central bank increased significantly by 82.45% in December 2016, owing mainly to the increase in oil prices. Total outflows, however, spiked during the same period. The committee noted that the average naira exchange rate remained stable at the interbank segment of the foreign exchange market during the review period.